Hello, everyone. Thank you very much for joining us today. Gary made all the introductions, so I'll go immediately into the topic. So as we are all aware, the current macroeconomic environment is characterized by lots of challenges, including but not limited to high inflation, geopolitical tensions, supply chain disruption, and of course, technology innovation. And all of that, of course, has lots of impact in both consumers as well as lenders. That's why I'm very happy today to sit here on a panel with Jason and Calvin. Clive, right? Just to talk about the Canadian landscape, right? And how do we ensure that Canadian consumers get access to credit while at the same time lenders are able to drive, revenue for the business. So, Jason, let's start with you with a bit of an introduction, as well as we want to hear your thoughts around the current macroeconomic environment and the rising cost of capital.
Sure. Yeah. So Jason Mullins, GoEasy's president and CEO. We're a non-prime consumer finance business, serve the 8.5 million Canadians with non-prime credit scores. The macro environment, I think, is very clearly challenging for all businesses. In consumer finance in particular, the higher rate of interest environment is increasing borrowing costs, and increased borrowing costs just put more pressure on the economic model. That means that businesses have to find ways to either reduce operating expenses as an offset or reduce credit losses as an offset by lending to a less number of borrowers. And the model is simply, when you look at consumer finance, there's revenue, it's cost of funding, losses, and operating expenses. Those are the three components. It's as simple as that. And as one changes due to a macroeconomic factor, you have to maneuver and change the other levers.
Thank you very much.
Yeah, thanks so much. So Clive Kinross, I'm one of the founders and the CEO of Propel Holdings. Propel is a fintech company who provide access to credit in the form of unsecured loans to consumers on both sides of the border. We started in the US 12 years ago and entered the Canadian market about a year ago. Certainly impacted by rising rates. Not only are we impacted by rising rates, but maybe more importantly, borrowers or consumers across Canada are. From our perspective, we have fixed rate products. So as interest rates go up, our cost of capital goes up, and it's gone up quite materially in the last year or so, further eroding our margins, if you will. But unlike prime or super prime lenders, we don't increase our rates at the same time. So if you look at what's going on with credit card companies, for example, credit card balances are the highest they've ever been in Canada. At the same time, prime customers, prime and super prime customers are paying 20 to 25% on their interest rates. That's a function of what's happened in the economy and interest rates over the last few years. And once again, in our model, we just absorb the cost. We don't pass on any increases to our consumers. Our consumers are going through a challenging time. I would say, just as we contrast the US to Canada, I would say consumers in Canada are more stretched than they are in the US, despite the fact that unemployment is at or near an all-time low, which is a positive on the one hand. Wage inflation is going up, and maybe it's even going up a little bit more in our segment of the market relative, say, to the prime and super prime segment of the market. But at the same time, if you look at the way our mortgages are structured in this country, they come due every 5 years, unlike the US, where people can lock in rates for 30 years. So as these mortgages are coming due and payments are going up materially, it's really having a materially negative impact on consumers across Canada. And at the same time, you've got new regulations that are aimed at lowering rates that we could charge even more, that if anything is just going to put even more strain on consumers who won't otherwise be able to access affordable credit. I think we'll touch on that a bit later.
Thank you very much, Clive. What are the regulations? You touched on the regulations, but what do you think are the regulations and trends that will really shape the way that we, lend money to consumers?
Yeah, I mean, I think at the risk of oversimplifying, consumer lending is as simple as the basic economic waterfall that I described earlier. There's the rate charge to the borrower that generates the revenue, and there's really just three lines: the cost of funding, which is the cost of goods sold, operating expenses, and losses. And those are the three main categories that get deducted from revenues to generate a form of profitability. Most investors in consumer lending, and particularly the non-prime market, expect 20% returns. That's just the very common and typical hurdle rate that most lenders operate by. That's a function of investors knowing that they could choose less risky and other alternatives investments to deploy their capital. And so to enter into the consumer lending marketplace, particularly in a category where there's a higher level of risk, that needs to be commensurate with a higher return. And that's a basic investment philosophy that everyone would understand. So in order to generate a 20% return, you've got those three inputs that have to be managed. Regulations, which often can determine the maximum allowable rate that can be charged, therefore ultimately determine the number of people that qualify for credit. As maximum allowable rates increase or decrease, the number of people that a lender can approve is going to increase or decrease. And it's a simple function of pricing the loan according to the credit risk of the borrower, the inputs of the OPEX, the cost of funding, and then the return hurdle that's needed. The regulation being referred to is there is an intent by the current federal government to lower the maximum allowable rate, and that step down is likely to occur at some point next year. And that unfortunately means that as lenders, all of those other components of our economic model don't change, but rather the one thing we then have to do is bring down the loss risk associated with those highest risk borrowers as the rate that we can charge reduces. And so unfortunately, the simple reality of it is it just means there'll be a cohort of individuals that would have qualified for licensed regulated credit today that will have to look at alternative sources, whether it be payday loans or other illegal forms of lending.
Yeah, and I'll just go off of that. Look, first of all, we need regulation. Obviously, we need regulation. Financial services companies need regulation in particular. Otherwise, companies will run roughshod. So certainly, we're right behind regulation, and we take compliance as a company very, very seriously. And I think what Jason touched on from a regulatory perspective, probably the most critical item that's really top of mind right now is the recent rate cap bill that was introduced, lowering the criminal rate in Canada. That's such a horrible word, but be that as it may, that's what it's called, from effectively a 47% APR to a 35% APR. And the backdrop, by the way, for this rate cap is a banking system that, according to the learner study in Canada, is the least competitive banking system out of all the G7 countries in our country, Canada, over here. So, you know, that really works to the detriment of consumers who are paying our banks more money than consumers are paying banks across the planet. And on the other hand, at a 47% rate cap, you've got one of the lowest rate caps, not in the G7 countries, but in the entire planet. And it's with that backdrop that the Canadian government is attempting to lower the rate cap bill. And if I may just give a quick kind of synopsis or history lesson over here. I may have some dates wrong over here, but in 1980, they introduced the current interest rate cap of a 47% APR, and that led to the proliferation of payday loan companies who saw a gap in the market operating in what I would call the gray zone. That industry just mushroomed till about 2006. There were a couple thousand payday loan stores across Canada. In 2006, in essence, what the federal government did was codify what was going on into law and said that there'll be exceptions to the usury cap of 47% for payday loan companies, described at $1,500, a $1,500 loan and unsecured. That was, in essence, an acknowledgement that these loans need different economics in order for lenders to be able to provide these products. My friends at Go Easy, and I'm not even sure if they're friends or not, they're actually our competitors, but be that as it may, did an incredible job when that came out back in 2006 and developed a product that was lending to consumers at 47%. Taking volumes away from the payday lending companies while miraculously being able to provide credit at 47% to these consumers. I didn't think it was possible. It's why we started in the US 12 years ago and only been in Canada for a year, it's very difficult to make money on smaller dollar loans to consumers in that fashion. Go Easy have done exceptionally well over the last, over that period of time, while payday lenders have gone, have reduced more and more and more of them have reduced at the same time. And now what the government would like to do is lower the 47% to 35%, in the hopes that that will lead us to lending to consumers at rates of 35%, which we can't do. This is a highly, highly competitive country. If anybody could lend at 35% where their competitors are lending at 47%, we would do it all day long. It's a simple way of taking market share. To borrowers, pricing is very, very sensitive. Instead, what will happen, not dissimilar to what's happening in Quebec, that today doesn't have the 47% rate cap, they have the 35% rate cap. These guys lend in Quebec at 35%. The percentage of the population that qualifies for 35% in Quebec is not that dissimilar to the percentage of the population that qualifies for 35% below in other provinces in Canada. However, if your credit profile doesn't qualify for 35% APRs, in Quebec, you're shit out of luck, excuse my language. And therefore, what do? There are 68 illegal lenders in Quebec. Globe and Mail studied this a couple months ago, who are lending from Canada, from the US, from the Caribbean, from South America, from Europe, to Quebec consumers, charging them rates of 6, 7, 800%. That's what's going on today. And if that should happen, that this cap gets lowered, that unsecured loans need to be offered at 35% or less, we can't do it. I could tell you right now, we can't do it. We could fund some at 35%, and we're funding those folks today at 35%. Our APR start at 19.9. But what's going to happen of the 8.5 million odd underbanked consumers in Canada? That's the CLA's data, that's the TransUnion's data. Roughly 4 million of them are going to be pushed to much more higher cost forms of credit. So the very people that the government is purporting to protect over here, they're going to put their lives into peril. We've seen it in California, we've seen it in Illinois, we've seen it in South Carolina, and there are plenty of other models in the US and across the globe where the same thing's done, and the playbook is consistent time and time again.
Thank you very much for the global update and the history. I want to hear, and you have shared some strategies on how to maintain, a more healthy portfolio given all the constraints. I want to hear also from you, Jason. What do you think, in your opinion, right? What are the different strategies that can ensure that you have the return on equity while at the same time you're able to allow credit to your clients?
Yeah, so I think regardless of the existence of where regulation applies, all businesses, including consumer lenders, are trying to find ways to run their businesses more efficiently and more effectively in order to be able to not only return the necessary hurdle to its investors, maybe over time increase profitability, but ultimately deal with the kind of macro headwinds we're talking about, regulatory, cost of funding, et cetera. And for a lender, again, there's really two ways to approach that. One is to get better at making credit decisions so that you can be more accurate in predicting risk and bring down your relative loss ratio relative to the population that you approve. By bringing down the loss ratio relative to the number of customers you approve, by getting better at decision sciences, that makes the business more effective and more efficient and allows you to recover some of the margin erosion that we're experiencing through higher funding costs or the regulatory changes. So lots of work gets done in a business to try to figure out how to make the credit models and the underwriting logic that we use more accurate and more predictive. Today that tends to use both a combination of new alternative data sources and more sophisticated analytical tools. And then the other line is the operating expense line, trying to find ways to run the business more efficiently, using more digital and more technology to automate processes, make the staff, make the contact center more productive and more efficient as well. Where it gets tricky is a lot of times in non-prime, the conversation that we have with the customer, whether that's live or over the phone, is really important to setting them up for success. So that operating expense can really only be pushed too far before you actually strip costs out of the business that actually compromises the likelihood the customer is set up for success and can fully repay the loan. We think that the conversation you have with the customer to walk them through how the loan works, how credit works, the terms and conditions of the loan is a really important investment in the operating costs of a business. So figuring out how to get more accurate with decisioning sciences so that you can bring down relative loss ratios, figuring out how to get more efficient with your operations so that you can bring down operating costs, those are the areas that we tend to find get the most investment and most innovation in the business today.
Great. So, Jason, you raised two really good points around how do we make more accurate credit decisions, and then how we improve, operations through, automation and all that, which leads quite nicely into technology, new entrants, innovation, and all that. Would you like to share your thoughts on that?
Yeah, sure. And by the way, we're talking about innovation in a very tricky time. I'm sorry to be harping on the point over here, but there's this cloud of lower rate caps that we've got coming in, and at the same time, interest rates are going up. It's one of our biggest inputs. If I were to just put it into perspective, because I think Jason did a good job of articulating in their world what their costs are. But if we were to contrast, a payday loan is $1,500 or less. If we were to offer a consumer a $1,500 loan, payable in equal installments over a calendar year, the costs to the consumer would be about, just calculating off the top of my head, I think about $340. Give a consumer $1,500, they pay us $340 over the course of a year. Forget about that markup, $340 on a $1,500 product. Find me any other business on the planet that could operate with those margins, let alone lending to risky consumers over the course of a year. But that's our margin, $340, and that might go away while payday lenders stay in place. So we've got $340. Of the $340, you've got a good chunk of those consumers who'll just default. Our loans are unsecured. We can't collect on them. We can, let me restate that. We can collect on them, but we can't repossess a car and sell the car and get our money back in that way, which is why we need the extra cushion. So you've got defaults is a big cost of ours. Our marketing and acquisition costs are high as well. We do an outstanding job lowering our marketing and acquisition costs through data, through analytics, through different channels that we know work for us. But at the end of the day, very, very difficult to get that cost under $200. And we're best in class. We have people, we've got a team of 450 people at our company today who are working with people on the front end, who are working with people over the life cycle of the product, and also working with them should they default. And our cost of credit, I don't need to tell you this, but our cost of credit is 13%. We're a publicly traded company. You could go look at what our cost of credit is. And by the way, that's kind of below market. Now, GoEasy have structured their debt a while ago, so they're even further below market, but we're operating in that kind of an environment today. Let's just say that it is exceptionally challenging. Everything that we do through technology. We've got a best-in-class proprietary technology platform that's got a big AI backbone that's been all built in-house. We've got a tech team of about 80 people. We're doing more and more automation of the loans and the loan process. In so doing, being able to take costs out of the business in the form of people, pass those savings on to the consumers, either in the form of lower costs of credit, provided they qualify for it given their risk profile, or alternatively being able to provide credit to more consumers than we would otherwise do. Our AI backbone is also critical in being able to underwrite these consumers, but at the end of the day, the machine learning that we do, which takes into account about 5,000 data points, is critical with 12 years of data, but just as critical is the stance that we and the judgment that we apply when approving loans. And my final comment I'll say is not dissimilar to what the banks are doing today, where, by the way, their underwriting has never been tighter. That's coming from TransUnion. That's not coming from me. We're also tight with our underwriting, given the risky profile today. So that's kind of where we're triangulated from a judgment standpoint currently.
Thank you, Clive. Jason, do you want to share your perspectives around technology and innovation, new entrants, and what do you see in the market at the moment? And how that can enable, again, back with the 2 points that you raised around better credit decisions and then, improving automation in operations?
Yeah, I think one of the unfortunate things about a difficult macro environment like the one we're facing is the fact that, and whether that's because of higher cost of funding or regulation, all of these are macro conditions that put more pressure on the business model, is it actually hurts innovation and hurts competition. As the economics of the business become more challenged, it means the barrier to entry now gets higher and you experience a lesser number of new entrants. And as we've seen in many other industries throughout Canada, that hurdle rate then means you end up with a smaller number of companies, generally just those that have meaningful scale, operating in effectively an oligopoly. And although on one hand, you might think that as a business, why would you not want to operate in an environment where it's you and just a small number of companies with scale? The reality is as a business person, part of this community, I believe that competition is essential, because that competition is what drives creativity and innovation. And it forces all of the companies operating and competing to have to get more creative with coming up with better solutions, better technology, better products, better services, and the customer ultimately ends up winning. What industry in Canada do we know of where there's only a small number of companies with significant scale that own the marketplace, where you would say you get an exceptional experience, that are constantly pushing the barriers and the envelopes of creativity and innovation and developing really inspiring products? That's very rare. The industries in which we think of that don't have oligopolies in other countries are the ones where we tend to look toward the technology and the innovation. So all businesses will be purposefully pursuing the use of technology and innovation to get more efficient and more effective, as I suggested earlier. But as it relates to the competitive environment and what the macro conditions are doing to stimulate innovation and competition, the current climate in reality is reducing the number of competitors. We see the number of companies that we're competing with bidding on keywords that are used to acquire customers dropping year after year after year. It's just unfortunate that the macro conditions are actually going to, in the end, hurt the consumer, because there will be less companies servicing them and then less competitive incentive for those companies to want to find more ways to innovate and drive value to borrowers.
And if I could just add a couple of points. I've already made the point about consumers being locked out of the market and being pushed to more expensive forms of credit. But if you just follow it through, companies are for-profit organizations. So you then turn around and say, well, how are they going to make up for this loss in profits that they're incurring otherwise? For the consumers that qualify for rates below 35% today, all that companies are going to do is just charge more to those consumers. They'll add 1% or 2% to make up for the shortfall. So all that will happen at the end of the day is it's a lose-lose. It's a lose for those who qualify for less than 35. They'll pay more than what they otherwise would have done, and those that are higher will pay a lot more than they otherwise would have done anyway.
Great, thank you very much. I want to make sure we keep Gary, happy, and we are on time. So we talk about regulation, we talk about technology, innovation, how do we manage and maintain a healthy portfolio while, making sure that we also drive revenue, all right, for the business. So now I want to hear from both of you, since you're CEOs in your company. What keeps you awake at night, maybe beyond, the regulatory environment and all that? What is something that is top on your agenda for the upcoming year that you might want to share with this group?
I think we, like all businesses, I think, are just generally worried about the future economic conditions, and in particular, how the major banks and government are going to grapple with the rising interest rates and the effect that's going to have on mortgage renewals over the next couple of years. I don't worry much about our business and our ability to manage it. We, I think, have developed a long track record in being able to proactively manage credit and manage risk and do the adjustments and things that are necessary to manage through those macroeconomic headwinds. So I don't worry about our business, but I do worry about the state of Canada and where we're at. The fact that Canadian household debt levels are as high as they are, and that you've had this generational rapid rise in rates that are going to hit like a wall and affect consumers and their mortgages in the next couple of years. And at the moment, with the view being that rates will be higher for longer, it doesn't feel like the banks and the government have yet found a solution for what they're going to do when that time comes. And that is going to put, unfortunately, a lot of stress on borrowers, and particularly those that own homes, that are already facing difficult challenges with the cost of credit and the cost of living. So again, I feel very good about our business, because I think as a lender, there are lots of things you can do proactively long before you face an economic, a period of economic turbulence in the business, to be well prepared, and we've done those things. But as far as just what I worry about in Canada and in our financial services system and marketplace in general. That is for sure, I think, the thing to be most concerned and most worried about. And until we see the banks and the government come out and put a real practical solution and plan together, it feels a little bit like a game of chicken right now to see who's going to act first and do what first to prevent that from being a tidal wave problem for the country.
Thank you. Clive, do you want to share your thoughts?
It's not dissimilar. In fact, most of Jason's thoughts, I've found myself nodding my head over here. You know, banks in Canada, we've already said how uncompetitive they are. This isn't like a Silicon Valley Bank scenario where we saw the ripple effects of one out of many thousands of banks having their meltdown and the impact it caused on the financial system. Anything happens to any of the banks in this country, the ripple, we don't have a country left because they're all so interconnected, and what will happen to one bank will happen to all the banks. And the big risk right now is real estate prices and real estate mortgages, and all of the banks have huge real estate mortgage books that they're concerned about, and they're tightening underwriting as a result. As it relates to our business, they're not going to get into our space for a couple reasons. First of all, they've got bigger problems. Second of all, they don't know how to do it. They've tried. TD and Canadian Postal Service tried for a while. Didn't go particularly well, I think for a month or two before they shut down and said it's not as easy as they thought it was. BMO have just closed down their auto lending units. They're buttoning down the hatches right now. So the truth of the matter is I actually don't lose sleep over regulation. I choose to kind of lose sleep over the things that I can control. So we're doing all we can from a regulatory perspective to impact that, but at the end of the day, that's all we could do. I think our business model has proven exceptionally sound for the last 12 years. We've been operating profitably since year 3 or 4, which is about as early as you can do it in this industry. And at the end of the day, not only do we have the concerns with what's going on with the economy, but there's obviously huge geopolitical risks right now. Feels like there's a lot of hatred, and it's picked up a lot in the last week or two. And what concerns me, not so much as a CEO, but as a citizen, is if something happens to credit in this country or to consumers' ability to pay their bills in this country with a mood of this kind of a geopolitical backdraft, it's very concerning to me, and a fertile ground for lots of potential ugly things. So that's what I would say I'm losing quite a bit of sleep over at the moment.
Thank you, Clive, for helping to put everything into perspective, really. So thank you very much, everyone, for joining us today. Hope you enjoyed the conversation. If you want to discuss anything further, feel free to come and join us, and we're more than happy to help and clarify anything. Thank you very much for the discussion.
Thank you.
Thank you. Thanks so much.